Inflation is an economic reality that can impact the purchasing power of your money. However, instead of letting it create financial challenges, why not explore opportunities to make money during inflation? In this comprehensive guide, we'll delve into various strategies and actionable tips to not only navigate but thrive in times of inflation. I dedicated hours to sift through interviews of Warren Buffett while preparing for this video. Before moving forward to discuss topic, make sure to subscribe to the channel and hit the bell icon so you won't miss any future videos we upload. The least favorable investment during an inflationary period is holding on to cash. Warren Buffett shares this sentiment, and he's not alone in his aversion to cash during inflation. Fellow billionaire Ray Dalio has emphatically stated, "Cash is trash." This stems from the fact that in times of inflation, the value of cash stashed in a savings account or tucked away at home diminishes daily, weekly, monthly, and yearly. A crucial takeaway from this video is that as an investor, you must evaluate your returns in what's known as real terms. The calculation is straightforward. Imagine your investments yield a solid 10% annually. Sounds great, right? Well, it depends on the inflation rate. To determine your real return, subtract the inflation impact. For instance, if inflation is 7% and your investments return 10% that year, your real return is only 3%. Not as thrilling as it initially seemed, is it? This explains why cash resides at the bottom of the hierarchy. Holding cash essentially yields a zero return, and over time, the effects of inflation work against you. Just above cash on this hierarchy are fixed interest rate bonds. While conventionally perceived as very safe, Buffett argues that these investments aren't as secure when you factor in inflation's impact. Allow me to elaborate. Presently, the yield on a 10-year U.S. government bond hovers around 1.8%. Purchasing such a bond today locks in a 1.8% annual return for the next decade. However, let's consider a scenario where inflation averages 4% over the next 10 years. Not far-fetched, given recent reports indicating a 7% inflation rate. With 4% inflation, your annual real return would be a negative 2.2% after factoring in the impact of inflation on your return. While this is still a better option than holding cash, it falls far short of being the best choice. It's crucial to highlight that individuals holding fixed-rate debt, such as government bonds, face losses during inflation. Conversely, those who borrow money with a long-term fixed rate emerge as winners in inflationary periods. A notable example of this scenario is individuals utilizing a mortgage to purchase a property. In December 2023, I made the decision to buy a house. Securing a 30-year fixed-rate mortgage at 2.8%, I ensured that my interest rate remains constant for the next 3 decades. This also means that my mortgage payments will stay the same throughout the entire 30-year period. This setup proves advantageous, especially during times of inflation. The reason is simple. Inflation gradually erodes the value of the mortgage debt month by month and year by year. As each dollar diminishes in worth due to inflation, I have the advantage of repaying my mortgage debt with devalued dollars. This dynamic provides a significant benefit and positions me well in the face of inflationary pressures. Continuing in this hierarchy, Buffett categorizes the next level as unproductive assets, including items like gold, silver, and other precious metals. While these assets aren't necessarily disadvantageous to own during an inflationary period, as theoretically, their value should at least keep pace with rising prices for other commodities. They may not significantly enhance your purchasing power. Let's progress to the next category in our inflation hierarchy. As investors, our goal isn't merely to keep pace with inflation. We strive for investments that can surpass inflation and generate a real return. This brings us to what Warren Buffett labels as productive assets. While it's well known that Buffett amassed his wealth through stocks and entire businesses, he emphasizes that not all businesses are created equal. In the inflation hierarchy, productive assets take the stage with a focus on average businesses. These businesses share certain characteristics, one being their substantial need for additional capital, a more sophisticated term for cash, to sustain operations. Let's illustrate this point with a straightforward example involving a real company. Consider United Rentals, identified by the ticker symbol URI, known as the world's largest equipment rental company. Their business model is relatively simple. United Rentals purchases construction equipment such as bulldozers, portable restrooms, and heavy-duty trucks, and rents them out for short-term use, usually for the duration of a construction project. For simplicity, let's assume each bulldozer costs $1 million to purchase. Over its lifetime, it generates $1,200,000 in sales for the company, resulting in a $200,000 profit. Now let's introduce inflation at 20%. The next time the company needs to buy a bulldozer to replace an existing one, the cost has inflated to $1,200,000. Here's the challenge. All the profits earned by United Rentals must be reinvested in the business to purchase new equipment. In essence, the company can't extract any profits because they are absorbed by the need to replace aging equipment. While I don't anticipate such high inflation, this example illustrates the dilemma faced by capital-intensive businesses during inflationary periods. Before delving into the next business characteristic to avoid during inflation, let me share a quick anecdote. Charlie Munger, Warren Buffett's partner, once noted that there are two types of good businesses. The first allows you to take out the reported profit as surplus cash without affecting the business's performance. The second reports a profit but lacks any actual cash, an illustration that echoes the challenges faced by businesses relying heavily on capital. Moving on, another trait of businesses to avoid during inflation is the absence of what's known as pricing power. To understand this concept, let's contrast a company with and without pricing power. Apple serves as a prime example of a company with pricing power. Thanks to its loyal customer base, many Apple users are willing to pay whatever the company charges for its products, like the iPhone. The customer's decision isn't solely based on price. They're willing to invest in Apple's brand and quality. On the flip side, a company manufacturing plain white t-shirts, devoid of any design or branding, lacks pricing power. Customers in this scenario are primarily price-driven, opting for the cheapest option available. This company also faces the challenge of being unable to raise prices above competitors, as consumers will simply choose a more affordable alternative. In an inflationary environment, businesses lacking pricing power may find it particularly challenging to navigate. The cost of materials to make the shirts are increasing, the cost to pay workers to make the shirts are increasing, and the cost to ship the shirts to customers are also increasing. The only thing that isn't really increasing is the price the company can charge for its shirts. The most robust defense against inflation lies in investing in yourself. Strive to become the best in your field, whether you're a mechanic, lawyer, dentist, plumber, or accountant. By making yourself exceptionally valuable to others, you gain a unique advantage. In a market-driven economy, being highly valued allows you to set your prices, and customers are willing to pay for your expertise. That was all for today's video. You can share with us your views in the comments section. And if you are new to the channel, remember to subscribe to the channel and hit the bell icon so you won't miss any future videos we upload. Thank you for watching the video. Best of luck and goodbye.